Earnings per share is one of the most popular metrics used with stocks. Earnings per share tell us how that company is performing in that quarter or for that year. Earnings per share is a measure of the profitability of that business. And it's a way where we can value a company if we have a forecast of what their earnings per share is going to be. I'd like to take you through a valuation of a company using earnings per share. It's one of the two methods that I use on most companies. I principally use discounted free cash flows. That's where I get most of my value. But I also incorporate looking at earnings per share. Earnings per share is based more on what's the business doing now and what do I expect the business to do over the next 12 months. And I like to marry that with my discounted free cash flows. I already did a video on valuing a company using discounted free cash flows, and you can see that on my channel. In this video, I'll just cover earnings per share. What I hope to do is take one real life example and walk step by step through that example to get a valuation for a company. Let's get into it. Let me first take a look at the formula that I'm going to use, go over that, and then we're going to go get the data to fill in the formula. So my calculation looks at the intrinsic value of a company. If we look at the earnings per share of that company 1 year out plus its growth rate, and then I'm going to multiply it times the PE that I believe that company should get. So it's a pretty simple formula and it's pretty direct. I like simple and I like something that I completely understand. The company I'm going to use for this example is CrowdStrike. CrowdStrike is a security software company that sells into businesses to help them protect their data and their systems. This company's been doing well, and I'm going to use their data. Any website pretty much will give you earnings per share information as well as projections. It's projected that they're going to do about $4 per share in earnings per share this year. It's a very good number. And next year, they're expected to grow at about 25%, 30%, and then 42% for earnings per share. So I'm going to use these figures to get a starting point in my model and then use this as a growth rate as well. I agree with both. If I didn't agree with these numbers, I wouldn't use them. Now I've opened up my model and have it alongside the website where I have the information. So it makes it easy for me to put in the data while you look at what I'm referring to. So first, I'm going to take the full year for 2024 as a starting point. That's going to be $4 per share. The price to earnings ratio is something that I'm going to make the decision on. And I really have to weigh the industry, the value of the company, their growth rate. And I think that CrowdStrike deserves a 36 PE. That's a higher than typical PE. Why is that? Because they are in a space that's in high demand. They are a high growth company. And I think a 36 is appropriate. The growth rate, I'm going to go with 20%. It's projected next year they're going to grow by 25%, the earnings per share. But I like to be a little conservative. Based on that criteria, the model says that each share is worth $172.80. But the current stock price is $313 a share. So it's being priced at a pretty good premium if we value the company using earnings per share. Using earnings per share to get to a stock value is far easier than looking at discounted free cash flows. If you saw that video, you probably noticed there was much more data we put into a much larger model. This one is pretty straightforward, and I hope you found it interesting. Good luck investing in 2024.